I'm afraid Domenico has to leave, I think right now. So I would like to throw a question at you, but I don't want to have you miss a plane. You pointed out that interconnectivity and too interconnected to fail plays a role next to too big to fail. I wonder, how does interconnectivity and size in the financial system, and if you talk about banks, for example, are related? So are bigger banks in general more interconnected, or are smaller banks that are very interconnected as dangerous or even more dangerous than big banks which are less interconnected?
Well, I think it's...
Yeah, I think it's just talk.
Okay, great. Yes, this is something that we have to assess empirically. There are models that we have been developing in which, as a matter of fact, size and connectivity are strongly correlated, but other models in which this is not necessarily true. And another important point is that even if you break up big conglomerates, suppose that you are actually strongly pursuing the idea that you have to reduce the size in order to avoid the too big to fail problem. If there is a strong incentive to connect, to be correlated, that's not actually a solution to the problem. So this connectivity problem is separated from the too big to fail. I'm sorry that I have to run away. However, there are some co-authors in the room. Stefano Battistone has disappeared on purpose, but Joe Stiglitz and Mauro Delegati are there, so they can take up your questions. Thanks a lot for inviting me. Thanks.
I open the floor in a minute. But first of all, I have one question to all the three of you. In the 4 presentations today, we learned that interconnectivity plays a role for financial instability, that non-routine change and imperfect knowledge of the future is very important, and that debt and the build-up of debt is very important. I wonder, how do these 3 factors play together, and do they reinforce each other? Is it more or less complete description of the sources of financial instability, or what is missing probably? So if you take these things together, what would be your take on that?
Mm-hmm. Actually, let me just say, because I didn't have a chance to talk about the sort of policy implications of the model, but because we have imperfect knowledge, there is a range within which, although credit is occurring and growing, there's a lot of capitalism going on in the economy, and a lot of the policy proposals that we've heard seem to be wanting to limit the growth in credit from the very beginning. If we have imperfect knowledge, we have to be more circumspect about, when we want to start sort of cutting off behavior. And one of the implications of our model is that, asset price swings are an inherent feature of the economy, but sometimes they can become excessive. And only when swings in asset prices or perhaps in credit become excessive, that's when the government needs to start to sort of dampen the swing and sort of try to push the economy and the markets back.
Clearly, fragility and the level of debt are interrelated. If you have an interconnected system where people have very small amounts of debt, then one part going bankrupt doesn't cascade through the rest. So a major point of Minsky's argument was to talk about a society moving from a state of financial robustness to a state of financial fragility, and that is definitely correlated to a rise in the level of debt. So it all comes down to keeping debt levels at the stage where they're sufficient for the necessary investment role that it plays, but don't finance Ponzi schemes which end up leading to huge levels of debt, where even the breakdown of the smallest elements in the system can cause a crisis. Whoever would have thought that Murray and Park Kettle going broke could cause the crisis we're in? Well, it's only possible because Murray and Park Kettle were lent money on top of everybody else being lent money to the stage where the debt to GDP ratio, private debt in America, reached over 300%. So you have to stop the debt levels rising. That's, to me, the essential lesson from the history.
personally, I find it useful to sort of distinguish between the proximate and the sort of fundamental causes. And I think this is where our talks are kind of complementary in a way. I think if you're a central banker and you want to identify growing fragility, vulnerability, looking at credit aggregates makes a lot of sense. Yeah. But it doesn't tell you why credit is growing so strongly. And this is where imperfect knowledge economics might come in, and all other distortions might play a role.
So that is the fuel, and that is a fuel of instability. And for example, and imperfect knowledge is maybe one reason why the whole thing explodes sometimes, or why too much debt is being piled up in the first place.
Well, because of imperfect knowledge and because the fundamentals that markets look at tend to trend, swings are our inherent feature in asset price, our inherent feature of how asset markets help us allocate capital. But because markets are imperfect assessors of asset values, they don't get it right, even under normal circumstances. But sometimes prices can become so excessive that there's gross misallocation, and that's when the state needs to step in. Of course, how you determine that, I found these other talks very interesting because perhaps looking at credit growth and leverage and debt would be very important in trying to identify when gross misallocations of capital are occurring.
All right, so I would like to open the questions to the floor. Maybe we collect 2 or 3 questions. I would really appreciate if you could focus on the question part of your question. Jerry, right next to, in front of, the mic is right behind you.
Jerry Epstein, these are very interesting talks. I have a question for Moritz. Does your data allow you to distinguish between what sectors the credit was going in and how the degree of the severity of the crisis was affected by which sector the credit was going to?
All right, we take two more questions right here in front.
A very quick answer is okay. That's what our current INET grant is about. We collect disaggregate credit data. At the moment we cannot, but we're doing that right now. Yeah.
I have a brief comment and then a question. The comment is, in order to control and reduce the probability of these financial meltdowns, we have to look at the incentives that are faced by the decision makers in the process. Quantity constraints on outputs will not do that, I do not think. You have to look at why people have incentives to build up these Ponzi relations, etc. And the question I have is, I think we were very lucky in the last financial crisis that governments and central banks behaved properly to minimize the fallout of the problem. And we were very lucky because that's not going to happen again necessarily. And we need to talk more about how you cure the patient after the crash rather than just let's make sure the cars never crash, because they will crash.
Yeah.
And we should be out there right away as a discipline to say, hey, you've got to handle this problem. You've got to flood the economy with liquidity or what have you. We can't just talk about how to prevent it because that's not going to happen.
And the next question, Peter Jung in front, and then we bring it back to...
Very brief to Churaki. You said in one of your last slides that crises have occurred in different times when high capital ratios were low or whatever. Now there is a lot of debate that higher capital ratio may solve. So according to your statistics and your numbers, this is not going to be the answer. What is then the answer? As long as we have banks.
All right, so who wants to?
Maybe I just respond to Peter's.
Yeah. Can we answer? Okay.
Go ahead, yeah.
Okay. I'd love to probably take the second question first. I think what you have to do is make debt less attractive, because it takes two sides. Banks will always want to create debt because that's how they generate profits. So you can never stop them wanting to create more debt. What you can do is make debt less desirable for the public. I use the analogy that debt is, for the public itself, is actually like getting a tooth pulled by a dentist. You don't get more than one tooth pulled unless you're silly enough to let the dentist persuade you look sexier with less teeth. Now, fundamentally, what we've done is let banks persuade us that even though debt's a bad thing, it'll lever up any gains we might get on assets we buy, and therefore it's a good thing, enticing us into leverage, when in fact the growth in the leverage is what causes the price rise in the first place. So we have to find a way to cut that link between leverage and rising asset prices.
All right, we have, I think, two more questions. Roman and the lady in the middle.
Thank you, Steve, for this exquisite exposition of Minsky. And actually, I have a question to you that goes along the prior question. You see, this scheme of Minsky actually tells us where the connection between perfect knowledge economics and Minsky is. The two ways to do that, one is that you propose that we're going to cut off the credit. I suspect that's going to be tough, because we don't know where this thing exactly comes from, which institutions create it. We think it's shadow banking, we think it's this and that. But note that for the Ponzi scheme to continue, there are some possibilities of intervention in asset markets that would make the Ponzi scheme extremely costly to continue and to coordinate. And therefore, there's a demand side of credit. This is a little bit too aggregate income equal consumption scheme. And if you create a situation where the Ponzi scheme gets cut off by intervention, for example, on the risk side, the risk depends on the distance from the benchmark, and you increase significantly the risk, and then intervene directly and actually buy or sell assets, or increase collateral significantly, like the mortgage obligations and things like this, you might be able to redirect. Actually, Minsky tells us what to do. We want to make the credit that grows go less to the Ponzi scheme. There's two ways to do it. Is to be at the credit side or on the demand side for credit. To make the, and that possibility is what links our approach with this approach. And I actually have a question to the historian. To Moritz. You see, you have this leverage-intensive cycles. There's the same problem there. You have to ask the question, where is the cycle actually coming from leverage? We now have a new fashion that if leverage is some X, and if X moves up, the thing goes up. That's not an explanation. There just happens to be a correlation. There's some mechanism that connects these things, and probably one of the mechanisms, I suspect, and that's, I'm sure it's hidden in your regression, that beyond a certain level, the leverage acceleration leads to tremendous acceleration of prices, of asset prices. And when you go down, the simple Tobin theory will tell you that the value of assets goes beyond the replacement value, and as Keynes taught us, at that point you have to wait until you invest. It obviously doesn't make sense to invest when the market values of assets go low. That's Irving Fisher and Keynes, and that's probably what you observe. So you don't observe, when you have this experiment on investment in the middle ground, that's not about investment. This is about asset values, I suspect, although I don't know. It's just a suggestion. I really don't know.
All right. Please be very brief.
Is this on?
Yes.
Yeah, okay, it is on. I noticed the last speaker talked at the end about the importance of regulatory arbitrage. And one thing that emerges in terms of your 140 years of financial crises is how few there were in the Bretton Woods period. And if Bretton Woods did nothing else, it certainly reduced the possibilities of regulatory arbitrage. And I'm wondering, in terms of the various proposals we've heard, can you evaluate them in terms of how you can reduce those possibilities and therefore increase the likelihood of success of these individual policy suggestions?
All right, I think Moritz has to answer the question by Peter first.
I'll reply to the question about credit growth and trying to cut it out by regulation rather than setting up a situation that makes going into debt less attractive. I agree with Andy Haldane, that'll fail. And I think the regulators will also, except for people like Bill White, they'll get captured by the people they're supposed to regulate, as we've seen in the last crisis. If you try to get them regulating it, controlling it, the forces allied against them to make them do otherwise, when the Goldman Sachs of the world's grow in power and wealth is so enormous, they'll always buckle. So I don't think you can rely upon control mechanisms to stop that happening. You have to prevent it happening in the very first place by making the debt less attractive right at the outset and making it something that law courts defend rather than regulators.
I agree. Sort of agreeing with Bill White and Andy Haldane is always a good way. No, talking about liability capital ratios. So the Great Depression in America was actually when the U.S. economy went into the Great Depression. I'm not sure about the exact percentage, but a significant percentage of the banks in the state banks had double liability provisions, for example. Some had triple liability provisions. And it's interesting to see when sort of contemporaries in the Great Depression talked, you know, sort of in the run-up to Glass-Steagall, the idea of liability as a prevention of financial crisis went completely out of the window. No one discussed it anymore. That's not to say that we don't need higher capital ratios. I'm absolutely I think that's absolutely necessary for many reasons. Is it kind of a panicker for financial stability? I don't believe that. And I think sort of the lesson from history is that sort of the instability is really part of the system, and the question we might want to ask is, to what degree do we really want to dampen that instability, right? There's this example from ecology with forest fires where you have, you don't kill the small forest fire because that only prepares the ground for the really big one. So maybe there is an idea of we should not be too quick with massive policy responses when there is small incidents of instability, so that we have enough firepower when the big crisis really comes. I think capital ratios definitely play a role. It's something we're going to look at in our research, possibly for the size of the debt bubble and the cost of the crisis. That's absolutely possible. And so far it's an open question really what the net effect of credit booms is. We don't have a good idea. To some degree, there might be positive real economic effects of these periods of major credit extensions. Some might have growth effects, others don't. And we know they have real costs, but what the net effect of a credit boom is remains unclear. Just briefly on the asset price acceleration, we tried it with equity prices, but that's not a good, you want leveraged asset prices, so you want housing prices, and these, that's possibly another big project in data collection, getting long-run comparable house price statistics. We just don't have that. Yeah.
All right. There are lots of more questions, but I'm afraid time's up. Thank you very much for this very interesting and lively panel.